Today we have two special guests with us. Judy Canales, the State Executive Director of Farm Service Agency with Texas, is here again. And Mr. Darren Owens, who is a longtime friend and an Aggie also. He is the Common Management and Price Support is your area, which basically, in Joe's words, which you handle a lot of issues with regard to price support issues and payment limit issues in Texas. Is that correct?
That is correct. The common management is basically all of the eligibility issues for all across the board farm program.
And Judy, it's good to have you back with us.
Thank you, Joe.
With regard to information for the state of Texas, it's the partnership between Extension and Farm Service Agency has been long term, and I'm glad that we can do these because at the end of the day, this makes my job easier as being part of the education arm of Texas A&M. And if one producer listens to this or watches this video and sees and learns something they didn't know before, I've done my job, and hopefully y'all see it the same way on your side.
We certainly have, and again, it's an honor to join you again here at Texas A&M University and to be a part of a program and to talk about very important features within the Agricultural Act of 2014, also known as the Farm Bill.
Right. Well, we're specifically going to kind of to hone in on some of the loan provisions, and as most people know, when we start talking about what type of loans are available to producers at harvest and options they would have to do with their crop, we're usually talking about low price periods. And we're certainly in a low price period, and unfortunately, we are expecting to be in this type of low price environment for quite some time. So with that, it's a really good time to kind of revisit what are the options producers have. Specifically, you probably can talk to them about the market assistance loans versus loan deficiency payments.
Indeed, and first off, back to the notion of the Agricultural Act of 2014, the Farm Bill. What it did was re-energize and perhaps also reconstitute, reform various programs that the Farm Service Agency has held in the past and brought them up to a more current environment and certainly prepare ourselves for any challenges which certainly come around in the agricultural community. And so we're pleased on behalf of the Farm Service Agency to be able to come here and talk to you about what we believe are some important products that are avail themselves to producers. And first off, I always have to say that as per the conversation today, if a producer is interested and wants to learn more about these programs, we encourage them to contact their local Farm Service Agency office so that they can make sure that there are opportunities for them to sign up and to meet certain deadlines. And of course, first off, given the circumstances here regarding commodities and in particular regarding cotton and the still unfortunately low prices within cotton, what we're seeing are tremendous pressures. And while cotton is not a covered commodity under our current safety net program, agriculture risk coverage, price loss coverage, we have other options that we have been working with producers on who frankly have had a good working relationship with the Farm Service Agency. So we're here to talk to you about the marketing assistance loans as well as the loan deficiency payments, and then also perhaps an option regarding these certificates that a producer could avail themselves to, and I think make for a very important support that producer right now is seeking given the commodity prices.
Right. As we get closer to harvest, obviously producers need to know what tools are out there and how they work, so that there's not very much confusion as they harvest and they're started looking for whether they're going to put their commodity in the loan or whether they're going to do a loan deficiency payment right away. Darren, do you have any general comments you want to start with?
Well, thank you, Joe. The Marketing Assistance Loan Program is really the longest program that the Farm Service Agency has offered. It's been in effect since 1933. in the Agriculture Adjustment Act of '33 started us on the commodity loan program. And as you said, when commodity prices are low, it really gives an additional marketing tool to producers. And it increases the value of that safety net that we have in the marketing assistance loan. Not only the loan rate, but possible forgiveness of principal, which we commonly refer to as LDPs, or you hear producers talk about a POP payment.
Mm-hmm.
That was the old producer option payment that we called it prior to LDPs. And so it's really a great program to give producers an opportunity to orderly market their commodity and still receive a fair price, or at least a better price than they would have at harvest, possibly.
One of the things that happens, though, as someone who was working on this farm bill with the Congress, helping them behind the scenes, we didn't expect the prices to go as low as fast. And when one of the aspects we need to talk about later is the payment limits, how they will be a combined payment limit on these tools. Obviously, I can say right now I was wrong. I said that combining those limits that we'll talk about in a few minutes wouldn't be a problem as long as cotton prices don't fall, because that would be the big area where the value of, or the limits could be hit very quickly. And I don't know if I was wrong, or we didn't see it coming, because cotton prices have plummeted and they don't look to be coming up anytime soon. And so the certificate option that we're going to talk about is something that they really need to look at. So first, I'm not sure which one of you wants to visit, but with respect to a marketing assistance loan, just a mechanism. When the farmer harvests, they're going to come to FSA and take out a loan. That's correct on that, right?
Indeed.
Yes, it is. The producer comes in, and the commodity can be either farm stored or warehouse stored. Generally, most of our commodities are warehouse stored, and the producer brings the warehouse receipts or a bail listing in the case of cotton, because cotton, everything is now electronic, and the GIN will send a file to the office with the warehouse receipts. And the good thing about the loan is the producer can get a loan not only through the county FSA office, but through either a loan servicing agent or through a cooperative marketing pool. And it gives the producer some options, but it allows them to have some money up front. The loan rate on cotton, for instance, is 52 cents a pound. We apply premiums and discounts to the cotton, but the producer has a good option to come in, request that. It's fairly quick and easy, and the eligibility for the loan pretty much is be an eligible producer. That is, you've certified all of your acreages and you're not been convicted of some drug activities or other criminal activities, and in compliance with the conservation compliance requirements.
Well, one of the things I was going to ask you, Judy, was have we seen an increase in loan activity in the state of Texas?
We have seen an increase, and it's been an important product for us, this marketing assistance loan. Just in 2015, we did over $785 million worth of loans to producers. And so indeed, again, that's an important, almost it is a safety net as well too. And so we're glad that this is a continued service of the Farm Service Agency.
Right. Most people don't realize that these loans are coming at the end of the year, end of the crop year, but not into the end of the calendar year or fiscal year, and it allows them to pay back some of their bills while they try to market their crop and hope that price increases. So it's really a marketing tool that's used in this state a lot.
Indeed, and again, working through their Farm Service Agency office, or working through perhaps also a cooperative. Different mechanisms that we have in our state. Obviously, we have a long history of that kind of infrastructure, and so again, we're just pleased that this is a continued product that the Farm Service Agency has to offer.
Just to finish up on the mechanism, the marketing assistance loan, at harvest, Darren, they take the loan out. It's a 9-month loan?
Yes, it's roughly a 9-month loan. The producer then is, if it's warehouse stored, the producer then can anytime during that period repay the loan. There are some options for the producer to, especially for cotton and peanuts, to sign a form that allows a buyer to redeem those loans for them, and so that they can enter into what we would call option to purchase contracts, where producers can actually sell their equities and have an opportunity to get above the loan rate possibly. But that mechanism allows for that orderly marketing. It's about 9 months. It's like 9 months from the end of the month that you put it in the loan, so it could be close to 10 months, total, that you have an opportunity to market that commodity. The unique thing about cotton is as long as we're in a market gain or close to a market gain with the low adjusted world price that we have today, not only do we forgive interest on the notes, and we would forgive some principal as the LDP or market gain amount, but we also forgive storage. And that can be pretty significant if it's been in storage for 6 or 7 months, significantly increasing the value of the cotton to a buyer.
That's one of the aspects of these programs that the average person doesn't understand. There are a lot of benefits to producers from going into the loan, specifically in cotton with the not having to pay storage. So when it comes time to the 9 months is out, and they can either take if the situation we're in right now, where the repayment price would be lower than the loan or the effective loan, they can receive a payment for the difference.
Well, if it's already in the loan, when the buyer or the producer redeems the loan, in effect they repay the loan at less than principal.
Correct.
And so that is how much the principal that we forgive is actually the market gain.
Right.
So they do have to repay it. However, the producer does, these are all what we would call non-recourse loans, and the producer has the option of forfeiting the commodity to CCC if prices continue to drop, so that in full payment of the loan.
Right, and it's been 20 years now. It seems like just yesterday that we put in the marketing loan concept, which would allow producers to repay those loans rather than forfeiting them. It keeps from burdensome supplies being left year after year, which kind of hang over the market and keep prices down. So this isn't the way this program works, is encouraging the market to clear, basically, in my words. Yeah.
Well, indeed, also important here is the fact that it gives that producer some flexibility, so that they themselves can look at and make the best business opportunity for themselves, and not have to have any hasty or sudden decisions that have to be made. This gives them a chance to give them a little bit more time option for decision making, and again, that's certainly a good contribution, to the producer when they're in these kinds of circumstances of low pricing.
Right. Well, one of the things that comes with marketing loans is this issue if we marketing loan gains would be eligible for payment limits, correct? Unless they use certificates.
The market loan gain applies against a producer's payment limitation. In addition, the market loan gain requires the producer to meet all the actively engaged in farming requirements, cash rent tenant requirements, and the adjusted gross income requirements. So there's several more eligibility steps where now the commodity certificate allows that gain not to be counted against the payment limitation, not to require the producer to be actively engaged or meet cash rent tenant, and be exempt from the adjusted gross income requirements.
So there's certainly going to be interest in the certificates, primarily because of the payment limit issue. Unfortunately, when you have really, really low prices like we have, the adjusted gross income limitation I don't believe comes into effect quite as much when farmers aren't making, there's not a whole lot of income out there to be made. It can be less. It is a 3-year average. So any good 2 years and a bad year could average out where you still have an issue. But frankly, the way I look at it, well, our farmers are not really making very much money at this point, so having a high adjusted gross income is not very likely.
Where we've seen the adjusted gross income is primarily with all of the oil and gas activity that we had with landowners. And so a lot of the farm operators, yes, do not have adjusted gross income issues because of low commodity prices. However, a lot of their landowners or landlords have run into adjusted gross income. And this also assists in the marketing because now they don't have to split the commodity between the landlord and tenant because part is eligible, part is not.
Right.
Now it's all can be eligible, and it assists in the marketing of that commodity.
So just remind me, these what we used to call generic certificates or commodity certificates, which year did we stop using? We had them for 20 years, and then we stopped using them. In which farm bill do you recall?
In the 2008 Farm Bill, and so 2008 was the last year that we had commodity certificates.
And now this farm bill's this appropriations bill in December reinstated them. And again, I think the older producers are going to be familiar. Younger producers will not be quite as familiar with this tool because they haven't had access to them since before 2008.
They have not, but given the point of this frankly, more recent action of the Congress and authorizing this opportunity, again, it reinvigorates this certificate program and gives it some flexibility even for ourselves, for the Farm Service Agency to administer it.
Right.
And we just believe it's important that the producers know that this is an option for them to consider and to see would this pencil out for them in their operation. And again, given the changes, this is one option that we do have available for producers who are in the cotton business.
Right. Well, we've got these overheads that we're going to have on the screen various times today. The main things on this first one that we need to cover that we haven't talked about yet is loan deficiency payments. That is a mechanism. Darren mentioned it earlier. When I first started working in this job, people talked about pop payments, and it took me a little bit of time to figure out that they were saying pop and what that meant. And now I guess I'd just say, Darren, could you give the viewer the 30-second overview of how that process actually works with an LDP?
Well, for a loan deficiency payment, and which originally began as a producer option payment, which came up to the POP piece, it allows producers, if they agree to forego a commodity loan, to realize the market gain by taking a direct payment from that eligible commodity. Now, this does apply against the payment limitation. It is subject to all those actively engaged in AGI provisions. And that is combined with the total $125,000. So, and what we saw in 14 was in some parts of the state we saw some pretty large payments come late on corn. And those corn payments in many cases were limited because the producers had already earned a loan deficiency payment or market gain on cotton.
Right. And that's one of the reasons why I think that the certificates are going to be such a big thing for this current crop year. We've talked about it a couple of different times. Why don't you just kind of run through to make sure that I haven't confused everyone. In this bill, we have the $125,000 per person or per. I want you to go through that right quick. Everybody always asks me who's a person. When I use the word direct attribution, which is the new language that is applied, people's eyes glaze over. So can either of you quickly go through that for us?
Yes, Joe, the $125,000 limitation in a lot of ways gave a lot more flexibility to producers under the program than we previously had with multiple smaller payment limitations. So it allows producers to really make better decisions overall. But the way the payment limitation works, we used to have a deal called permitted entities, and it got very confusing for a lot of people. But under direct attribution, what that really means is your Social Security number can only earn both directly and indirectly the $125,000. Any single payment entity that earns a direct payment is limited to the $125,000. But if, for instance, you earn payments as an individual, those payments count against your personal limitation. If you also earned a share of payments indirectly through, say, a trust or an estate established by your father or mother, then those would count, that your share of those payments would also count against that $125,000 limitation, even though you personally did not directly receive the check.
I have been telling most producers in this state that there is a husband-wife provision that almost automatically will provide the wife with a limit as well. Could you talk about that?
Yes, there is a specific spousal rule, but now you also have to remember Texas is a community property state. And what's a little confusing is, even though we operate under federal farm programs, a lot of the rules that we apply to individuals, partnerships, and entities are based on the state law. And for husbands and wives in a community property state, they can choose to be either treated as a sole proprietorship, so Darren as an individual could participate, and his wife, Lori, would not necessarily be actively engaged in the business. And even though the husband and wife own everything jointly, we allow everything to be considered the husband's.
Mm-hmm.
Or they can choose to be treated as a joint operation, which means that the spouse says, I materially participate in the business, and then we would allow 2 payment limitations, and they would have those contributions. But what the spousal rule does is allows that requirement for labor and management under the actively engaged rules to be satisfied by only one of the spouses. And that's really a good thing for husbands and wives.
Absolutely. And again, there are usually teams in these activities out there, so this is a good thing. Well, one of the things that we were going through was on the loan limitations, and again, marketing assistance loan, we went through that earlier. Marketing loan gain, if a producer chooses to repay that loan, any gain they have, which would be the difference, would be subject to payment limitation, actively engaged rules, and AGI. Is that the way that works, Darren?
Yes, that is correct. The difference, which is the amount that applies against the payment limitation, and today on cotton that's about 7 cents a pound. And that's how much principal we would forgive that applies against the payment limitation, and that is the gain that the producer would realize and redeem the loan at less than principal.
Right. And I guess that kind of follows with LDP, which is, LDP in my mind is just a quicker version of get you out of putting in the loan. You're just going to get paid the difference on that particular day. It's subject to the same limitations.
Yes. When we first started the market loan gain process, as you know, we had turnaround loans, which we still will have under the new commodity certificate exchange part. But instead of putting it in the loan and redeeming the loan and then getting a check, this was just a short way to say, I'm not going to put it in the loan, but I want that market gain amount. And so we paid it as a loan deficiency payment.
And it is subject to the 3 as well, actively. I mean, you've got to
subject to the payment limitation, have to be actively engaged, have to meet the AGI provisions.
Right. With regard to the AGI, I know that's in your job description. You're one of the ones that deals with that quite a bit. How could you describe the AGI limitation? It's 900,000, but basically, what does that mean for a producer? How is it effectively done? I think I know that IRS is involved in this in terms of giving a yes or no answer to whether they've exceeded a limit. Could you explain that a little bit?
Yeah, the adjusted gross income in the 2014 Farm Bill changed to $900,000 per individual or entity. And we calculate that for individuals relatively simple. It's line 37 of their 1040, and we look at a 3-year average. But for like 2015, we would be looking at their income for 2011, 2012, 2013. And it's a simple 3-year average of line 37 of their 1040. Now, if a husband and wife happen to exceed that on the 3-year average, they can have a certified public accountant divide that income between the husband and wife on how it would have been declared and reported had they had filed their taxes separately. Even though they didn't file them separately, we allow them to do that. And that requires a specific certification. But really the process is a producer signs a form, a CCC 941, which is a certification that their income was less than or more than the $900,000. We in effect have the Internal Revenue Service then, we send that to them, they review that, and they run an average for us, and they basically tell us the producer exceeded that or did not exceed it. Or if there's some other problem with the tax identification number or they can't find the returns, they will tell us that information. We never see the producer's tax information unless the IRS says they exceeded the limitation. And in that case, we give the producer the opportunity then to prove that they may have otherwise been eligible. And that may require them to provide their tax information or a certification by a CPA or attorney to the Farm Service Agency.
Right, and for my work in extension and doing outreach across Texas, most people are hitting that limit are not because of the ag side. It's because of other sources of income that they're bringing that comes to their tax form. Is that what
That is correct, and good or bad. So if you retire and sell a business, or if you sell a piece of property, all of those things impact your adjusted gross income. Or if you leased your land and had a pretty significant oil and gas lease in one of those years, or oil and gas income in one of those years, all of those fit into that 3-year average. But as you're right, most producers that exceeded are not because of ag income, but because of other outside income.
One of the things that I probably should have mentioned earlier is when we start talking about this, we've talked about cotton a lot. And in most meetings with FSA, cotton isn't a covered commodity. You don't do that much with it. But this particular thing, cotton is a loan eligible commodity, as there are other loan eligible commodities that we haven't talked about, wool, honey. One of the things that I find very interesting in Texas is that the producers know very much what they have. They know all the rules surrounding grains if they're a grain farmer. But if they start producing cotton, they may not know quite all the rules. And the very first answer I give is to go see their county representative of FSA, the CED, because frankly, they need to know how this fits for them with these new commodities. We're going to see, with low prices, we're going to see people trying to produce oil seeds and things that they haven't normally produced. Are there any intricacies there, Darren, that we need to make sure that people need to know about? Obviously, the list of commodities is wide open. Unfortunately, most of this list, the prices are at levels that are below the cost of production, and people are trying to produce the least bad at this point option.
You know, you see soybeans and other oil seeds on this list, and those other oil seeds, we're seeing more and more activity in Texas. You hear a lot about canola, we hear some about flax, we do have some sunflowers, and all of those are classed in those minor oil seeds. And I would say if a producer's interested in planting a commodity that they've not been engaged with before, is one, check the FSA website with all of our fact sheets on those different commodities, and come by your local FSA office and spend some time with the staff and review what you're intending to plant, and they can give you the information you need about its eligibility for loan and how it applies under the other programs.
And I just follow up with that. Each extension economist out in the districts, we have 12 districts in Texas, provide budgets associated with these crops. Even if they're alternative crops, there'll be a budget. It may not exactly fit your property, but it'd be a good starting place so you can evaluate whether this is something you want to look at before you put the seed in the ground. Are there any other issues that we've forgotten here today that we need to be brought up?
I would not say necessarily that we have forgotten, but once again to stress that the Farm Bill had many different programs We've been busy implementing them in Texas over the last over 2 years, and I am pleased that in 2015 the result was over $2.2 billion worth of payments, including also our farm loan program, which has become very significant as well as always an important product and tool. And so, having said that, even with this change within the Farm Bill, that it is incumbent upon the producer to become educated, to work with Extension, work with your local Farm Service Agency office, and just make sure you're not missing something. And I think that's just given, there's always changes along the way in these programs, and what you may have recalled from the past may not be applicable,
right,
but something new's there. So we're just glad to be able to provide this support, technical assistance, and obviously financing.
Right. The main thing for my standpoint, the last message I like to make sure producers hear. We hear a lot of talk in Washington about the fact that we've moved towards a more crop insurance-based safety net. And I tell groups, and I'm going to say it again right here, without the safety net provided by FSA, this state would be in a disaster situation. When you talk about the amount of money that has gone out to producers, it's because of losses. We make these payments. The safety net has provided a undergirding of the losses and help mitigate those for producers all across the state. These programs are critically important, and as the work of FSA. I'm not going to say crop insurance isn't important either, but crop insurance isn't keeping people afloat at this point in time.
Understood, and indeed, if you look at the trends over the last, frankly, 3 years, 2013 we did $1.9 billion worth of business. In 2014 we did $1.6 billion, and then, as I mentioned, $2.2 billion in the fiscal year 2015. So that was the original intent from almost 80 years ago, 90 years ago, in the formation of these our legacy organizations that are now, we are of course now known as the Farm Service Agency, but from the past. And it's incumbent upon this country to remember that when you've got, here in Texas, there is indeed about 250,000 producers, granted at small, medium, and large sizes,
Mm-hmm.
but they're there, and they're part of our customer base. And even with the disaster program that have been made permanent, switching into the conversation regarding livestock here in Texas,
Mm-hmm.
that was a big opportunity for us to be able to work with producers here in our state and help them to start to rebuild after the severe drought. So we're in place because of the unpredictable nature of agriculture and everything that occurs as a part of that industry.
Right. Well, thank you very much.
Thank you.
Do you have there?
Just one quick, Joe, one reminder for those, especially cotton and peanut producers that have already signed what we would call a Form CCC 605 or 605P, which gives a buyer the authority to redeem commodities they've already placed in the loan. In order for that buyer to use a commodity certificate, it's important for the producer to come by their local FSA office and complete a form called a 694-2, which would give that buyer then the ability to repay that loan with commodity certificates, and that way protecting the producer from those payment limitation issues. And it's important, they have to sign that before the buyer redeems the loan. It's very important to do that today.
Well, thank you both of you very much.
Thank you.
Enjoyed this.
Thank you.